They didn't do it during the day. They didn't do it when markets were alert. They waited for quiet. Tuesday night, December 23rd, just before Christmas Eve, while families were unplugging, while traders were off desks, while banks were running on holiday mode. That's when the rules changed. At 11:47 p.m., the CME Group quietly dropped an emergency notice. Silver futures margin requirements were raised by 75%. What required $15,000 yesterday now requires $26,250 overnight. But that wasn't the end. At 1:15 a.m., the CFTC followed up with emergency position limits on silver contracts. And then at 2:30 a.m., just hours before Asian markets opened, COMEX issued a warning about potential trading halts due to extreme volatility. 3 announcements, 3 regulators, 3 hours. That's not coincidence. That's coordination. This is what I call the Christmas trap. They know they're losing the physical battle. They know they can't stop silver from reaching $100 through fair price discovery. So instead, they chose chaos. In the next few minutes, I'm going to break down exactly what happened overnight, how this setup is designed to force liquidation, and why. Unlike 2011, this move is likely to fail, because this time the system is weaker, and the buyers are stronger. What happened overnight? As soon as the announcements hit, the market reacted instantly. During the thin overnight session, silver was slammed down near $70. The goal was obvious. Trigger margin calls, force liquidations, create panic. But something unexpected happened. Buyers stepped in immediately. Price snapped back toward the low $72 range. And since then, banks have been fighting hard to push it lower again. This isn't normal trading. This is price whiplash, designed to scare people out before the real move higher. This is not a market anymore. It's a battlefield. The 3-step attack. Let's slow this down and look at what they actually did. Attack number 1. The margin shock, 11:47 p.m. One silver futures contract suddenly needs $11,250 more in collateral. Immediately. No warning. No grace period. Wire it or get liquidated. Attack number 2. The position cap, 1:15 a.m. Large holders are told to cut positions within 48 hours or face forced selling at market prices. Attack number 3. The kill switch, 2:30 a.m. COMEX reserves the right to halt buying or allow liquidation-only sessions. Translation: if the price runs, we shut it down. That's 3 levers pulled, all time when liquidity is weakest. The forced liquidation math. Now here's why this setup is so dangerous and so intentional. Imagine a hedge fund holding 3,000 silver contracts bought at $68. Earlier in the week, they needed about $45 million in margin. They had $50 million. They were fine. Silver rallies. Their position is massively profitable. Then suddenly, overnight, margin jumps to nearly $79 million. They're short almost $29 million. It's Christmas Eve. Banks are closed. There's no way to raise that cash. So what happens? They sell. Not because they want to, because they're forced. That forced selling pushes price down, which triggers more stops, which causes more liquidations. That's a trap. And yes, this playbook worked once before. Why 2011 is not 2025. Back in 2011, silver ran to $49. Margins were raised repeatedly. Leverage collapsed. Speculators were wiped out. The rally died. But here's the difference. 2011 was paper-driven. 2025 is physical-driven. This time, 3 forces don't care about margin hikes. Force number 1, physical shortages. There's a massive supply deficit. Raising margins doesn't create silver. Force number 2, industrial demand. Tesla, Samsung, solar manufacturers. They buy metal, not futures. Force number 3, algorithmic hedging. Banks sold massive call exposure. When price rises, computers must buy no emotion, no fear. Margins don't stop math. Who really controls the metal? Think about this. A grandmother in New Jersey owns physical silver, she bought decades ago. She's not watching futures charts. She doesn't know what CME did last night. And halfway across the world, an industrial buyer is staring at inventory levels, trying to secure metal to keep factories running. Who has leverage here? The person holding real metal, or the system holding paper promises. That's why this setup breaks. What comes next? Yes, there may be more volatility. Yes, we may see another dip. But watch what happens when Asia opens. If COMEX dumps paper to $1.68 and Shanghai prices stay near $1.82, that spread tells you everything. Paper broke. Physical didn't. That's how you know the trap failed. Final thought. This isn't about charts. It's not about one night of volatility. It's about control. Regulators can change rules. They can pause markets. They can scare weak hands. But they can't print silver. And when physical demand collides with paper promises, history tells us how that ends. The empire made its move. Now we see if it still has power, or if this was its last bluff.